Hey, what's up, guys? Hope you guys are doing really well today. Okay, so in today's video, what we're going to be discussing is DOVs, DeFi option vaults, and why it is the future of DeFi. Okay, so in here, I have, as you can see from the presentation, I've made like a presentation, and which it'll be describing these 5 points in general. Basically, what is DOVs? And how the previous iterations of DeFi, that is the money markets, farming, and bonding, how those were, the solutions of the past, and why DeFi wasn't scalable or sustainable. And also, like we'll be looking at like how DeFi was done previously or is being done right now, and what are the different innovations in DeFi going forward. And we'll also be looking at like how DOVs itself can actually go ahead and like sustain and scale DeFi to massive heights. Okay, so let's jump in. Okay, but firstly, let's just take a look at like what is DOVs basically. Okay, DOVs is basically, it stands for, the abbreviation, the full form, it stands for DeFi option vaults. Okay, so from that itself, you can tell like these are dependent on options, which is a derivatives, which depends on like the derivatives markets, and also it's a form of a vault. That means it's like a safe, like and you can put your funds in there or your assets in there, and these are those sort of like vaults. Okay, in general, basically the functionality, how it works is you have an asset, let's say Solana or BTC or Ethereum or any asset. You can go ahead and you can stake these assets in these vaults or these services or these dApps, what we call decentralized applications, which are basically open source protocols. And this can help you generate yield or generate passive income through different strategies, okay, through options and through derivatives, okay. And so basically, in a nutshell, it's basically just a structured product, which is very automated for the end user, and it's accessible for to anyone, to anybody, to with a person having $1 billion or $1 trillion, or maybe let's say $1, you can access this right now in DeFi, okay? So yeah, a couple of things, just to note that these sort of like structured products was only available previously in the traditional finance, world through OTCs, the over-the-counter, institutions, and these were only available to accredited investors, in the sense like investors who were registered in the sense like that means they have large amount of funds and they have capital to deploy. They have like maybe $1 million capital. That's when you are an accredited investor. So it wasn't accessible for you and I, and all the retail folks out there. You need to be an accredited registered investor with like huge net worth, and also like it was available, like you could execute options, you can trade options in Deribit, in the crypto market. You could do it through Deribit, like using BTC and Ethereum, but it's very manual process, and you actually need to know, you need to actually be an expert in derivatives to actually do that. But right now with DOVs, it's very simplified, okay? And it's very automated. But firstly, we're going to look at like how DeFi actually initiated this whole yield generation, like how you can actually earn passive income, was started. It started off with like, all these MakerDAO, Compound, and all of these protocols on Ethereum, because Ethereum was the first smart contract chain, I would say. Not, I would say like that is that was the first smart contract network. So I would say money markets was like the version one of DeFi. Okay, so basically it had like two main functions, lending and borrowing. That means, let's say you had capital, as you can see from this picture, from this image over here, from Compound. There's a supply market where, let's say you have a certain token or a certain asset, you go ahead and you deposit that asset in Compound and in the dApp. and they give you a certain APY. If you look over here, there are different APYs. That means you can generate certain amount of yield, just like how you deposit your funds to like a traditional bank, right? Not traditional fund, like they give you 0.01 probably, or maybe nothing, to keep your capital over there. But in DeFi, you get much more, way much more than that. Okay, and this is just like an example that I'm showing you, just to simplify it. And then you also have the borrowing markets, where people, let's say you want a loan or you want some liquidity to do some trading or stuff like that. You can go ahead and you can actually borrow some funds by providing a collateral, and you can mint you can actually borrow this liquidity which is available in those dApps for a certain APY. Okay, so let's say you're getting a loan from a traditional bank, you do have to pay like an interest, right? So it's the same case in DeFi, but it's just like the DeFi markets are much more better and it's much more global. Okay, it's not restricted to a particular jurisdiction or like a country or something like that. It's available for everybody. Okay, with an internet connection, of course, and a wallet, a crypto wallet. But anyways, those are the money market, the version one. Okay, remember that. AMM, okay? AMM is basically automated market makers. Okay, automated market makers in a sense, this is like Uniswap. If you know Uniswap, SushiSwap, and all these decentralized exchanges, where you can go ahead and like trade, let's say Ethereum to, you can convert Ethereum to USDC, which is a stable coin. You could do that. So basically, these are all these automated market makers where you can go ahead and do that, and stuff like that. So basically, that's an automated market maker. Now, in this case, like why this one is, I would say, like the version 2 of DeFi, which is also in play right now. And basically, what you need to do over here is basically in order to create that market, creating a market in the sense you need to have asset A, asset B. Okay, so someone has asset B, but they want asset B, so there's a pair. Okay, so in order to create this pair, in these automated market makers, you had the option to go ahead and add liquidity in the sense add capital. Let's say you had asset A, you could go ahead and deposit that. Let's say you had asset B too, you could go ahead and like put this asset into these dexes or these AMMs, and you can actually once you do that, you stake that asset, which is you're creating a liquidity pair. You actually earn some incentives, which is basically like you earn some incentives through like when someone trades, any of these two assets, you generate like trading income from that AMM. And also on top of that, there is something called as you could do farming, you could do yield farming, basically yield farming in the sense you could take these assets and you can actually generate a lot of high APY, okay? And basically, as you can see over here, this is just a snapshot of Tulip Garden. It's one of the yield um, aggregator in Solana, and they offer like, as you can see over here, yearly APY of like 5,300 and 309.999 percent APY. So, but this is just like a sample, okay? It gets like way crazier. It goes like a way, I mean, in across DeFi, because yeah, and as you can see over here, like I explained previously, asset A, asset B. Asset A over here is MBS, and asset B over here is USDC. So basically, they're creating a market. So creating a market, how? By when you add capital to this market, depending on the risk, they give you rewards, okay, in form of like different tokens. They offer you their governance token of that protocol. Governance token in this case of Tulip protocol, okay, just which is Tulip. There's a token for that. So basically, those are some of the methods which are still being used in DeFi, and this is like the version 2, I would say. The third version of DeFi, which is what we commonly right now know, like in from through quarter four or quarter three of quarter three of like 2021, we came across like this Olympus DAO. Like I'm just taking that as an example. There's like 70 other folks of Olympus DAO right now. Basically, they introduced this concept where actually these protocols could go ahead and own that liquidity that you added over there. And why did they do this? Because usually when people yield farm, they are always looking for high yield or higher APY. So basically, people, when the APY is really high, that means there are a lot of DeFi investors or speculators who come into that market. They create a liquidity pair and they get all that APY and they dump on the market. They dump the token, and they generate income for themselves. Yeah, and all that stuff. So basically, that's what they did. It's very short term, narrow-minded, and when the APY is dropped, they used to go somewhere else. Okay, they used to take their liquidity and just go somewhere else. But bonding, when you do bonding, it's actually basically, as you can see from this picture over here, A and B asset, you create this liquidity pair in an exchange, but and you give this asset to the protocol. In this case, I'm using an example of Olympus DAO. So you give this asset pair to Olympus DAO and you get Ohm token. Okay, Ohm token is the governance token of, like, it's a token, it's a utility token within the Olympus ecosystem, and you get that token in return, and you get that after the bonding period is done. Okay, generally I guess like it's like 7 days over there. So, and you get that token upfront. Okay, so you don't need to yield farm and all that stuff. Okay, so basically they introduce that, which is mainly, I would say, like it called it like bonds as a service. So basically this mechanism of when you offer the liquidity pair and you get a token and you bond it for like 7 days, it's called, like, I would say, like bonding as a service. Okay, so basically this was like the version 3. And also you have the whole Terra ecosystem. The main protocol over there on that side would be Anchor protocol, I would say. So it's very attractive right now. Why? Because DeFi users or anybody, can go ahead and like deposit UST, which is a stable coin on Terra, and it is an algorithmic stable coin, one of the first, I would say, and it generates like 20% APY, which is paid out in Anchor token. Okay, users who stake UST, as you can see from this image, that the APY, it's pretty stable across that time. So it fluctuates, but it's very, very thin. But it's a new concept. Okay, and it's been working pretty well, I would say. Okay, in general. So those were like some of the concepts which are being used right now, and this just very broadly. Of course, like there are different other very detailed strategies that you can do and generate yield and all that stuff. But broadly speaking, these were like, these were like the innovations, the core innovation would happen in DeFi. Okay, but why is like all these versions that we spoke about, the money market, or like, the AMM style of yield generation, yield farming, and this bonding as a service, and this Terra, with the USD sort of a market, why is all these like not so scalable? I mean, yield farming is not scalable. That's guaranteed. But why is it all these not so scalable? Because all these versions or all these innovations in DeFi, were primarily, it was dependent on like a token. Okay, but let's see like what were, like, some of the concerns what people face. Like, I've been using DeFi, I know this, and if you've been using DeFi as well, you know this, like, um there's a huge sell pressure. What do I mean by sell pressure? When, like I explained previously, when people go and create this liquidity pair, they actually generate a higher APY in the beginning. Okay, and in the beginning they generate a higher APY. That means a higher return in terms of, like, the token that they receive from the protocol. And what they do is they collect all these tokens and they go ahead and they dump it in the market. That means basically they sell it. Okay, so there's huge sell pressure in the market, And and also the second thing is there is impermanent loss. That means if you're creating a trading pair which is of one is a volatile asset, one is a non-volatile asset, which is a stable asset, you create like a concept or like a thing which is called impermanent loss. You can Google this, and there's a lot of definition and how it works and examples like that. So you create that. That means you lose value of one of the asset, and it just rebalances differently. Okay, so yeah, you will see, and you can go ahead and like Google this out. And also, the third thing is temporary liquidity. Like I mentioned previously, people go there for just the high APYs and they leave very quickly. Okay, they once the APYs start, decreasing, people take their liquidity and just they go away. And also, the price volatility of the token that they are receiving, from this protocol as an incentive to give their liquidity or to lock up their liquidity and stuff like that, or to stake or stuff like that. Yeah, as you can see, like, according to Nansen AI, which is one of the softwares or one of the tools which looks into all these analytics of all these DeFi and crypto markets in general, they mentioned that a whooping 42% of the yield farmers that enter a farm on the day it launches exit within 24 hours. That means on the first day of the launch, 42% of the yield farmers that launches exit within the next 24 hours. Around 16% leave within 48 hours, and by the third day 70% of the users would have withdrawn from the contract. What this basically means is like people, like I mean, investors, speculators, everyone, um, they don't want to be there for a long time because the incentives keeps on decreasing because it depends on the token, the token distribution, because the token emission, I would say, the emission of the tokens, how they are paying the higher APY. So basically, once that goes down due to the emission being lower and lower day by day, the APY also keeps dropping. So that's why there's no lot of incentive to be there. And also the price of the token, maybe the token that they're receiving in form of like yield, the price of that token keeps decreasing, so keeps being lower and lower because of the sell pressure, so those are some of the concerns, and as we can see over here, like it's dependent on the price inflation of the token. If the price of the token keeps going up, then yeah, probably it's sustainable. But like I mean, that's not how market works, and crypto market, that's not how it works. It just goes right up and right down, for like something which is very, very new. And if it's successful, yeah, like I mean, we saw this with Olympus also, like it just goes up, and then they manage to like steady the ship, and who knows what will happen in the future. But we'll see, But it's good that people are innovating all these versions, and so on and so forth. But uh, but basically, what does this like really mean? That means the yield, the passive income is largely it's like mainly it's like artificial, or I would say like it's synthetic. Why? Because they have this token emission as the base layer, how they generate these high yields. Okay, and it's basically like a circular process. It's like a rinse and repeat process. The virtuous cycle of a yield farmer or a DeFi degen. You just keep going in the circle looking for higher APYs and going to new one again, sell, go, sell, look for higher APY, sell that token again, go back, and so on and so forth. And now there's different ways, like it's not just that, but I mean, you could do governance and so on and so forth, which is still in the, it's in the early stages, I would say, but it looks optimistic, that you see all these different types of innovation. But now, we're going to take a look at like how DeFi was done. You get some differences in how DOVs, DeFi option vaults, how they do it and how it was done previously. So DeFi previously was very manual, like I said, like I mentioned previously, you need to be really active in all these groups like Telegram or like Twitter and like Discord and stuff like that to find these protocols and to ape in or like like, to be there early, so that you can generate this. So it's very manual process. It's very tiresome because the crypto market is 24/7, and it's basically all a smart contract, so anybody can actually launch all of this. But DOVs are much more automated. It's all structured into this vaults type of thing where you could go ahead and stake into this vault. But in the other versions of DeFi 1, 2, and 3, what we have seen is you need to create and add liquidity to in this pairing, or like, some of them, like in Solana, they have like single side like liquidity pairs. But anyways, it still remains the same. The base APY is generated from the token emissions, what these protocols give out, okay? And it's not that scalable or sustainable. It's not like it just lasts for like maybe a month or two, and then it's like almost there's no action happening, because it goes to like from 10,000 APY or 20,000 APY to like probably 1% or something like that over a period of time. So it's like it's not scalable, not sustainable. Okay, and that's not like what actually would offer real value to solve real world problems. This is good because we as like, speculators and investors, or like whatever you can call us, retail players, we want to actually use these technologies and to understand this and these types of products. So in the other case, like DOVs, it's just like it's much more scalable and sustainable. Why? Because it's just like stake your asset over there and you forget it, okay? And you don't need to know a lot much, but you need to be well informed. You don't need to be an options expert to actually use DOVs. You just need to be well informed. Like, hey, what's your outlook on the market? Are you long on the market? Are you short on the market? What's your outlook on the market? And also, you have this concept of impermanent loss in DeFi version 1, 2, and 3. But with DOVs, you don't have that. You don't have liquidations as well. And DeFi previously, like 1, 2, and 3, it had a lot of like dependency on like the tokenomics, how you create the tokenomics. But in this case, DOV, it depends on the structure of the market. Like I said, long or short. Are you long or short on the market? That's it. And previously it's like it depends on the price volatility of that asset, which you receive yield in. But in DOVs, it's mainly like the volatility of trading of in the whole market. How's that going? How is that looking? And so on and so forth. But anyways, how does like, DOVs, how can it scale and sustain DeFi? Here are some like just gist of it. I'm just putting this in very easy to understand way and with some examples. I hope it's easily understandable. But just wait until the end because I'm going to share some dApps which does these DOVs. Okay, so you can go ahead and do it yourself. And try all these products and understand actually and make sense of for yourself, like is it for you, is it not for you, for your risk tolerance, and so on and so forth. But anyways, how does like DOV scale and sustain DeFi? Basically DOVs, it brings in like a base yield. What do I mean with this? That means all these options, like DeFi options, all these options that are being traded, it's being sold to the market makers. Okay, so market makers pay a premium on those vaults to get those to actually bid, for those option contract, and they pay that yield is given to the users who stake assets in DOVs. Okay, so basically, as you can see from this process of DOVs, that like you stake your asset, you stake your let's say for example you stake Solana, and let's say these option like they create options contracts in the options protocol in Solana, and basically market makers who want to buy or who want to bid for these options, they give you a premium, in so that means in upfront they give it to you upfront. Okay, so that means there is no token involved, that yield that you receive is not in the form of like a token, which is like a protocol token. Okay, it's a base yield that the market makers are giving you in the form of the native token that you staked. Okay, and also like what you could do is you could layer this base premium with different token rewards. As you can see over here, premiums is the market makers are paying premium on that. So that's the base yield, which is not dependent on any token. And what you could do is you could add another layer if you want to actually provide high APY. You can add in much more token rewards on top of it. Like I mean, those vaults can actually create a token for themselves, and they can say, hey, people who staked on these vaults are going to get additional tokens. Or they could also introduce something as like commonly known as like staking and governance, on top of that, so they can create this triple layer of like yield generation: the base API from the market makers, the token, they can wrap a token around the vaults and they can generate these tokens, or they could introduce like something like governance or staking to generate additional yield, in the token, for the DOV. So it can scale. So that means like token rewards and staking and governance was used in like DeFi V1, 2, and 3. They can use those techniques as well on top of the base organic technique, like yield generation technique, which is the options premium. Okay. Now, what like and basically what this does is this opens a whole new door for like the derivatives market, okay? And this makes it much more scalable because why? Why is it scalable? There's more liquidity in the market right now, there's more liquidity in the market, and it makes much more scalable than a spot market. Spot market is basically when you buy BTC from an exchange or like an app on your phone and stuff like that. This is much more like an hybrid DeFi, okay? So hybrid DeFi in the sense, most of it, like the elements which are like trustless, in this DeFi option vaults, like let's say your investment or like I mean, the management of the collateral and the price discovery of like the asset itself, in the market, and also like I mean price discovery, and basically all the like price, yeah, all these sort of like trustless elements, which are um which are supposed to be like it doesn't need a trust of anybody. These are all on chain, okay? Only the risk management part, which is like a non-linear sort of like an element, that one is off chain, okay? So basically what this does is, and it's a very transparent process because the yield and all that management stuff is done on the chain, so you can actually see it, you can see the transaction was being done, and so on and so forth. So it makes it a much more transparent system. You don't need to trust any third party or stuff like that, because you can see what's being done, and you also, most importantly, you get this premiums upfront, or you get this yield upfront, okay? So that's it's pretty insane. And also the fourth point is like there's no liquidations because there's no collateral being added, or you're not borrowing against the collateral. I would say, like for example, like if you put BTC, if you add BTC as collateral, you can actually in some of the services in DeFi, and even in some of the CeFi products, like centralized finance products, you could actually withdraw, or you can loan some stable coins, let's say, okay? And let's say if the price of BTC falls, you need to add more BTC in order to keep your position. If you don't add more BTC, it's just going to be liquidated, okay? But in DeFi, it's much more riskier. They don't give you that time to, you need to actually assess it very carefully, and you need to borrow in a certain L to V. The loan to value ratio needs to be managed properly, so you need to be very good at like risk management first. But anyways, that's like the primary. First, you need to manage the risk, and then second is the return. Okay, so that is always the strategy. Manage your risk, be in the market, don't get fucking liquidated, and then second comes the return. But usually, sometimes people think in the other way around. They think, hey, how much can I earn? How much can I earn? But like, but the main thing is like to see what risk are you taking. Okay, so but in DOVs. You don't need to worry about any liquidations or stuff like that. It's straightforward, easy, simple. And also the third thing, the fifth point, which is it would actually help the altcoin markets to become much more liquid, much more capital efficient, because these derivative markets is different. It's like a totally different market, which is massive, much more massive than the spot market. Spot market in the sense like, the general asset market, so and also like I mean, previously all these sort of like um, uh, these DOVs were like I mentioned previously, it was offered through Deribit, it's like an exchange, you could do it only with BTC and ETH. And I mean, what we have seen like since like the mid of like 2021, we have seen a lot of like liquidity flow into these Ethereum like tokens and the ERC20 tokens, okay, which is a standard for launching any token on Ethereum. So you could do this like on other protocols as well, of course, like like Solana and like Avalanche and so on and so forth. So basically, it'll provide much more liquidity for different players in the market, like investors, speculators, market makers, and DAOs, and treasuries, all sorts of like treasuries and foundations and stuff like that. So it's pretty insane to see this, and I mean um it's like a pure form of like innovation of DeFi. It's not like some Ponzi scheme with like with this token wrapped around it, and like you get this high 10,000 APY or 20,000 or 1,000 million APY. And you're like, is this fucking real? Like you be like, is this real? And what is the risk? And like you keep thinking all of this stuff. But here it's very straightforward. Why? Because all these structured products were actually it's been used for a lot of years in the traditional finance market, so people are aware of all of these, but now it's being brought into DeFi, and all these traditional investors are looking for all these types of structured products because they know it works. It has worked in the traditional markets since the yield in traditional market is way much more lower, and DeFi is like maybe like 10, 20, or maybe 100x like higher. The yields are higher because the volatility in the market is higher, so there's much more opportunities of yield, and people all these institutional companies who are reaching out to all these big investors, or like these traditional investors, they're offering all these structured products, the GOVs, but right now, what's the situation? It's like you have like very simple sort of like strategies. One is called like the covered call strategy, and the other one is called like a cash covered put strategy. So when basically the people generally tag this as like covered call and put selling. So basically, covered call is basically when if you're like relatively bullish on the market, you go with a covered call option. Let's say you have in this case, as you can see over here, you have a BTC covered call. So basically what that means is like, let's say you're long BTC. That means you're optimistic that the price of BTC is going to increase over a period of time. Okay. So you go ahead, you put your you can put your BTC to work in this. So basically, once you do that, you earn an APY of 23.6%, which again comes back to the market maker who's bidding on these options, and they are paying you this. They're paying these protocols like these higher APYs or higher yields, and that's how like these protocols actually generate these yields and sustainable for the users, for the DeFi users who are using this right now. And put strategy on the other side is basically when you're like when you're short on the market in the sense like when your outlook, when you think that hey, maybe the prices are going to drop and so on and so forth. So that's why people tend to go to stable coins. In that case, they try to trade and convert their volatile asset, like let's say BTC in this case, into like an USDC or a stable coin. So basically, if you do that as well, you have a strategy for yourself over here. You have a vault where you can go ahead and it's a cash covered vault in the sense like USDC or any stable coin, stuff like that. Any stable coin, you can come and you can like stake it within the vault, and you can generate yield on that as well. Okay. Now, basically, what the DOVs, what are they doing basically? Like why? Like I mentioned previously, this is like a pure DeFi innovation, okay, which has been proven to work in the TradFi system, and it is going to exponentially be really useful and explosive in the DeFi ecosystem, okay? Because basically what they're doing is they're disrupting the whole derivatives market and the options and structured products, this whole market, okay? And like they're basically disrupting how this was done previously in the past, and because in the past there were like so many intermediaries, so many third parties that you need to rely upon, but right now with all these DOV, it's just making it very simple, like you have seen previously over here. These are just vaults. You just click a button, you go deposit, and that's it. You're done. You don't need to do set and forget, okay? But you just need to know what you're doing basically, okay? You're not actively trading, okay? And also what it does, it makes it simple, it makes it accessible to a person with like let's say $1 billion, or like a person with like $100 or $1. You can still access these products if you want. Right now it's accessible, okay? And not just that, like I mean, it's not limited to like just covered call or put selling strategies over here. It will expand to different sorts of like structured products. People can do like NFTs. They could create a vault for NFTs to make the NFT market more liquid, to so that there's more capital in that market and stuff like that. This is insane. Like I mean, it's just like it depends on the imagination of people. And also it depends on the risk. To be honest, like I mean, yeah, I mean, depending on the risk, there will be a certain premium, where a certain premium which will be paid for those sort of contracts or those sort of like vaults, you would say. And it just would continue, but this is like a very core innovation, okay? Just understand that it's a very core innovation which we have seen since I would say like um mid of 2021, I would say, like when actually this started to come into play, and you had like different DOVs in Ethereum and stuff like that. So yeah, so basically, like in general, like what they're doing is they're creating this whole full all out derivatives market, and they're gonna make like it's gonna make trading much more efficient, and the whole capital market within crypto ecosystem much more efficient. And they're just doing this only by smart contracts. As you know, like in DeFi, it's just smart contracts. Everything is like smart contract. It's just a piece of code with like a front end over there. That's it. And you can do that. Now you don't need to go to a fucking bank or like to some I don't know, some institution or a hedge fund to do this and pay them like a 10% management fee and blah blah blah. Over here, DOVs minimal to negligible like fees, and yeah, so that's how they will earn an income, like to by a small management fee, because they do it on that side automatically through algorithms, and also yeah, whatever they do, because they are experts. So what we need to be is we need to be well informed investors or speculators if you want to access and use this product. So basically, just do that homework, okay? But for now, what we're gonna do is like I'm gonna share with you four of the protocols which are doing this, and these four protocols are on Solana. Why Solana? Because it's much more cheaper to access this product, much more easier to play around. The user experience is much more better, and it's just cheaper. Why do you want to pay like $100 to do the same thing thing where you can just use Solana and pay like some like cents, a fraction of a cent, to play around with all these DOVs, so and that's why Solana. So what I would do is I would leave this presentation, in the description so you guys can go ahead and like go ahead and try all these products and take a look and leave a comment what you guys think after exploring this. Do you like it? Do you think it's going to work? And like, are you looking to explore this whole DOV stuff? Because I am I am going to explore all of this DOV stuff because it's pretty insane. Like this the base concept, without having a token, how are they generating this? And it's already like I mentioned previously, it's already proven just in this case in DeFi, like, I don't want to sound like a fucking broken record or something like that, you need to be aware that these are DeFi protocols, and it all depends on smart contracts. So smart contracts, they have risk, as you're aware, and yeah, different other things. Crypto market, it's volatile, and I think it's good that it's volatile, so it's much more there's a lot of opportunity in the sense, so consider it like that, and I think if you are into DeFi, you know this very well. But yeah, so that's it for today. I hope you guys enjoyed it, and if you learned something or if you want to know more about it, leave a comment and drop in your comment, and probably I'll take a look. I'll take a look into your comments and let's see how you guys are thinking about this. And let me know which one you like best out of these four. Okay, for me, I would say like I like friction and katana, and the other ones. Okay, like shit. Okay, so let's see. Yes, katana, friction, and then you have like tap. Okay, so just give me a second. Okay, anyways, I'm gonna edit this and I'm gonna share it with you guys. All right, bye now. Have a nice time. Cheers.